Hi, and welcome to Chapter 1's Exercise Review Lecture. As you can see, there are various exercises that we will be looking at during this review. Remember, you should have tried these already on your own before watching this presentation. So let's start with Exercise 1-1, which is on page 37. In Exercise 1-1, there are several transactions that took place during the first 2 years of operation for a law firm of Pete, and Roy. And you can see those items listed. In addition, you learned that the firm incurred utility costs of $35,000 in year 1 and that there were no liabilities at the end of year 2. No anticipated bad debts on receivables, and that the insurance policy covers a 3-year period. Calculate the net operating cash flow for years 1 and 2. Prepare an income statement for each year similar to illustrations 1 to 4. And then determine the amount of receivables from clients that the firm would show in its year 1 and year 2 balance sheets prepared according to the accrual accounting method. So we're diving right in. Let's see where we ended up. So here are the transactions and information again. The amounts billed are the amounts that went out in the mail as charges. Cash collected, of course, is the cash that was sent to the company. The cash disbursements list each amount that was paid during year 1 and year 2. In our first requirement, that's what we're focusing on, the net operating cash flow for years 1 and 2. So we would first start with the cash receipts from customers because that's the actual cash collected. Year 1, $193,500, and year 2, $206,500. Cash disbursements for year 1, $65,000. Salaries paid to employees for services rendered. For year 2 then, $75,000. Year 1 utilities would be $30,000 cash paid and $50,000 for year 2. And finally, the insurance policy, $48,000 for year 1 and $0 for year 2. We're just focused on cash that we collected and cash we paid out. So, in year 1, the net operating cash flow would be positive $50,500. The $193,500 inflow minus each of the outflows, 65, 30, and 48, $50,500. Year 2's cash flow would be calculated the same way. Start with the $206,500 receipts and subtract the payments of 75 and 50. You would get $81,500. That is cash flow accounting though. Let's look at requirement 2 that says, well, now prepare an income statement for each year similar to illustration 1-4 using accrual accounting, which accrual accounting says we record revenue when it's earned, essentially, and expenses in the accounting period they happen or they're incurred. So now we need a little more information. First of all, remember an income statement is a major financial statement and it's usually the first one prepared, and it's where we list our revenues and expenses. Now legal fees revenue would not be $193,500, but for year 1, the amount billed, because if we're billing it, we completed the service during that year. So $200,000 in services were completed in year 1, $210,000 in year 2. We ignore the cash collected from customers for purposes of this statement. Now let's go and see what kind of expenses there are. Remember, expenses are amounts incurred to provide a product or service. The first one, salaries expense. Salaries expense for services rendered during the year. Sorry, utilities expense and then insurance expense. Let's get those all out of there. So the first year, salaries would be $65,000. The second year, $75,000. There's no other information to change that. Utilities. And let's see. These are a little different amount than what's in your book now, I'm noticing, and I apologize for that. I don't know why. But you saw the main information there. So utilities cost, the actual cost for year one was $40,000. That was given. So that's the amount of the expense. $30,000 was paid, but $40,000 was how much totally should have been paid. It wasn't. Year two, utilities of $50,000 were paid. Now watch this. Remember what cash disbursements represents, the amount actually paid. So of the $40,000 that was the expense for year one, only $30,000 of it was paid. So that means the other $10,000 was paid in year two. So we must subtract that other $10,000 from the total amount paid for utilities in year two to find out the actual utility costs, and that's where the $40,000 comes from. I know that's a little weird, but since they're telling us how much cash was paid, we've got to convert that to accrual accounting, and that's what we're doing. The insurance. The insurance covers a 3-year period. So $48,000 was paid out for 3 years. How much of it should be an expense in year one? Come on. 48,000 divided by 3, or 16,000. And then 16,000 would be an expense in year two, and then in year three they would recognize the remaining 16,000. That's showing you the difference between cash accounting and what we focus on in this course, accrual accounting. Total expenses then, we would add up those 3 numbers for each year and then get net income or net loss. Remember, we take our expenses, subtract them from our revenues. The net income for year one is $79,000. Net income for year two is the same amount, and that's just coincidence. So we saw cash accounting in step 1, figuring out how much cash we received or paid from doing our normal operations. And then we determine our net income or loss, which is based on accrual accounting standards, which says record revenue when you've earned it, record expenses in the accounting period they are incurred. And there's a comparison of the two. Now, the final requirement wants us to figure out how much in accounts receivables does the firm have? Would it show in year 1 and year 2's balance sheet according to accrual accounting? Well, you need to go back to the cash receipts from customers in year 1, $193,500. How much did we send out to customers? How much did we bill them? And if you think back to Accounting 111, billing means you've done the work and the customer owes you the money. So that increases accounts receivable. When they pay you, you will decrease accounts receivable. So it looks like when we take the 200,000 minus the 193,500, and there it is in the actual T account. Come on. The first year's accounts receivable balance will be a debit of 6,500. There's the billing of accounts receivable. Remember, we increase the asset accounts receivable when we bill. We decrease accounts receivable when the customer pays on that. In the second year, we billed 210,000. We collected 206,500. So we credit accounts receivable. If we take the 6,500 that was still owed as of the beginning of the year, plus the additional billings of 210, subtract the amounts received from those customers of 206,500, the balance of accounts receivables at the end of year 2 is $10,000. So wow, what a way to start chapter 1, jumping in and reviewing that whole idea of cash accounting and accrual accounting. Let's move on now to exercise 1-2. Very similar. The numbers are a little different than what are in your book, but that's okay. It's still the same concept. Amounts billed to customers for services rendered, very similar to what we did in the last exercise. Cash collected, payment of rent, salaries paid to employees, travel and entertainment, advertising. So we're just adding a few more expenses. In addition, you learn that the company incurred advertising costs of $28,500 in year 2. They owed the advertising agency $5,200. I'm already inverting numbers. At the end of year 1. So that was an accounts payable. Remember accounts payable. And there were no liabilities at the end of year 3. There's no bad debts on receivables, and the rent payment that was made in year 2 of $87,000 is for a 2-year period, years 2 and 3. So now let's calculate the accrual net income for both years. We're not doing the cash this side, just the accrual. So there's our information. Our revenues are the amounts billed, $381 and $490 for 2 and 3. Then we'll list our expenses. And now the dollar amounts. We paid $87,000, but we're not doing cash accounting here. We're doing accrual. So what time period was that rent for? 24 months. So half of it is an expense in year 2 and half of it is an expense in year 3. The salaries paid to employees will also be the expense amount. Travel and entertainment, same thing. The expense amount is the amount that was actually paid. But let's take a look at advertising. The actual advertising costs, and they tell us that in year 2, the expense amount is $28,500. Of that $28,500, okay, the company paid $16,500 in year 2 and $38,000 in year 3. But that's all we need to know for now. There's no advertising costs in year 3. Oh, I'm sorry, I'm wrong. Let me go back and look at that. So let's take another look at it. The company, I missed something there. The company started with a liability of $5,200 in accounts payable. So they paid. Oh, what am I doing there? Now I see. Okay. They had accounts payable of $5,200 that they owed on. they paid $16,500 and they incurred costs of $28,500 during year 2. So, as of the end of year 2, give me a second to get my calculator out. 33,700 minus 16,500. The amount that they owe in accounts payable is $17,200. During year 3, the company makes a payment of $38,000. Well, what's that for? Part of it is for the $17,200 that they still owe in accounts payable. Okay, they don't give us the advertising costs for year 3. We've got to figure that out. So, of that $38,000, the first $17,200 is paying off a liability. So if we decrease the $38,000 payment by that $17,200 accounts payable balance that's owed, what's left? $20,800. So that portion of the $38,000 is the actual expense for year 3. Now they figure it out a little differently on the slide, but that's the approach I take. So if you have any questions on that, please make sure you ask. After we figure that out, let's add up year 2's expenses and year 3's, and then determine net income or loss. In year 2, we'll take the $381,000 revenues minus the $284,500 in expenses. Net income is $96,500. And we'll do the same calculation for year 3's amounts, resulting in a $269,700 net income or profit. So a little bit more in depth, a little bit more thinking there. In requirement 2, we need to determine the amount due the advertising agency that would be shown as a liability at the end of year 2. Well, I worked that through with you, right? The accounts payable started with a credit balance of $5,200 because they tell us in the problem at the end of year 1, the company owed $5,200. During year 2, they incurred advertising costs of $28,500 and they paid $16,500 of it. So if we add the credits, subtract the debits, the balance is $17,200 that would be owed at the end of year 2. At the end of year 3, we would add the advertising, well, during year 3, add the advertising costs of $20,800, subtract the total payment of $38,000 that was made, get a zero balance. Why are we adding the advertising expense amount to advertising payable? The assumption is the day you debit advertising expense, you did not credit cash, but you credit advertising payable. That's the assumption there. So that is the answers for exercise 1-2. Lots of clicking. Apologize for that. Let's go to exercise 1-6, which now for each of the items listed below, identify the appropriate financial statement element or elements. What are each one of these? And there's our answers. So let's take a look at each one. And it's really, this is testing your memorization skills and remembering these items, because remember, in accounting, you need to know what the elements are on your different financial statements. If you stumble with that, you're never going to be able to move forward. So please, before you leave this chapter, make sure you know what's an asset, what's a liability, what's a gain, what's a loss, etc. So an obligation to transfer cash or other resources as a result of a past transaction. That's a liability. Dividends paid by a corporation to its shareholders. Distributions to owners. Inflow of an asset from providing a good or service. That's revenue. Remember, the asset could be anything. It could be cash. Somebody could pay you for doing a service with land or any plant asset. It could be a receivable. So it's usually an inflow of an asset. The financial position of a company. Assets, liabilities, and equity. It's the balance sheet. Increase in equity during a period from non-owner transactions. That's comprehensive income. That's the definition of it. Increase in equity from peripheral or incidental transactions. That's a gain. So a gain is just like a revenue, but a revenue is from normal everyday inflows. A gain is from something that happens once in a while. You sell a piece of equipment for more than its book value or its cost minus depreciation. A loss is the same scenario, but on the opposite side. It's the sale of an asset used in the operation of a business for less than the asset's book value. Remember, book value is cost minus accumulated depreciation. The owner's residual interest in the assets of a company, that's equity. Remember, assets equal liabilities plus equity. So when you have assets, you can use them to pay off liabilities, and what's left over of those assets are for the owners, or equity. 9, an item owned by the company representing probable future benefits, asset. 10, revenues plus gains less expenses and losses. Well, that's net income or net loss. An owner's contribution of cash to a corporation in exchange for ownership shares of stock, investment by owner. And what's an outflow of an asset related to the production of revenue? That's an expense. I like to look at expenses as a service we have to pay for to run our business day to day. So that is exercise 1-6, a great review of definitions. Exercise 1-7 now starts going into our different items in our conceptual framework. And I'm not a big matching problem, but in chapter 1, that's what we're dealing with. You will never see a matching problem on the test, though. But another great review of these various items in our framework. So let's go through each one. Predictive value is information is useful in predicting the future. Remember, these are all part of our conceptual framework. Relevance, pertinent to the decision at hand. So if it's pertinent to the decision at hand, it's relevant information. Timeliness, information is available prior to the decision. Distributions to owners are A, decreases in equity resulting from transfers to owners. Confirmatory value, J, information confirms expectations. Understandability, users understand the information in the context of the decision being made. Gain, we talked about this, increases in equity from peripheral, once in a while, or incidental transactions of an entity. Faithful representation is F, agreement between a measure and the phenomenon it purports to represent. What this means is that information is representing exactly what it's saying it is. Comprehensive income are the change in equity from non-owner transactions. And as we go through this semester, we're going to talk a lot more about comprehensive income. Materiality concerns size of an item and its effect on decisions. Comparability, C, important for making interim comparisons. Neutrality, M, the absence of bias. So we say financial information has to have no bias in it. Recognition, that's L, the process of admitting information into financial statements. Consistency, letter D, applying the same accounting practices over time. 15, cost effectiveness. It requires consideration of the costs versus the value of the information you're paying for. If it costs a lot more than the value you're getting out of it, it shouldn't really be done. And verifiability, letter I, implies consensus among different measurers. So in our lecture, we talked about these different items. This is a great way to make sure you understand and remember what each one really means. In exercise 1-12, we're now applying these assumptions and principles in our conceptual framework to situations. So let's take a look. For each of the following, indicate whether you agree or disagree with the financial reporting practice employed and state the accounting concept that you agree with or is being violated. So 1. Wagner Corporation adjusted the evaluation of all assets and liabilities to reflect changes in the purchasing power of the dollar. No, they shouldn't have done that. They violated the monetary unit assumption. Some people may put the cost principle there as well. Spooner Oil Company changed its method of accounting for oil and gas exploration costs from successful efforts to full cost. You don't need to know what those mean at this point, but they changed the way they're doing the accounting for their exploration costs. They don't mention the change in the financial statements, and the change had a material effect on the Spooner's financial statements. So it really affected them. It would change a decision maker's mind if it was disclosed. Well, it should have been, and that violates the full disclosure principle. In 3, Cypress Manufacturing purchased machinery having a 5-year life. The cost is being expensed over the life of the machine. Well, absolutely. That's the expense recognition. That's what should be done. In 4, Rudin Corporation purchased equipment for $180 at a liquidation sale of a competitor, but the equipment is worth $230. So they valued the equipment on its balance sheet at $230. No, disagree. We are still in historical cost in this in our country, the FASB. We recorded at its original transaction value, $180. 5, Davis Bicycle Company received a large order for the sale of 1,000 bikes at $100 each. The customer paid Davis the entire amount of $100,000 on March 15th. However, they did not record any revenue until April 17th, the date the bicycles were delivered to the customer. That's right. You do not record revenue until it is earned. Now, we're not talking about when they got the cash, they didn't do a journal entry. They probably did, but they didn't call it revenue on March 15th. They called it revenue on April 17th when they actually earned it, and that's what they did. It was proper. Gigantic Corporation in number 6 purchased 2 small calculators at a cost of $32. The cost was expensed even though they had a 3-year estimated useful life. That is fine. They are in line with the materiality concept. They didn't cost that much money. In $32 for 3 years. What's that, $11 not even of expense that they aren't recording? It's ignored. It's not, I always say materiality is, if it's immaterial, it's no biggie. Now we would need to know more about Gigantic Corporation, but it's by its name, it sounds like it's really big. So that's the assumption there. And then in number 7, Esquire Company provides financial statements to external users every 3 years. No. The periodicity assumption at least once a year, every accounting cycle. Okay, so those are the exercises that I have for us for review. Please make sure you understand all of them. Any questions, go on the discussion board or email me, and we'll make sure you are okay with what is confusing you. Now you should move on to your practice problems.